Hello guys, what's up? Welcome to a new video. This video is not intended to teach technical analysis. This video is intended to teach the very first thing that you need to learn if you want to succeed as a trader or as an investor. There's 5 golden rules that you must never ever break if you want to make money consistently in the long run. And these 5 rules are very simple, yet 90% of the people cannot follow these rules. For the simple reason that it takes a lot of willpower. Okay, so these rules are easy to follow, but it takes a lot of willpower and mental strength to be able to follow. Just like, for example, people that wants to lose weight, it's very simple. They only have to do 2 things: diet and exercise. It's very simple to understand, right? It doesn't take a lot of brains to know this. Yet 90% of the people fail to do this because it takes a lot of willpower and mental strength. So this would be the same comparison with trading. The rules are very simple, yet 90% of people are not able to follow them. So you need to have these 5 rules integrated in your mind 24/7 until they become a habit. Okay, so I'm gonna go ahead and go into these rules. I'm gonna be using the Ethereum versus USD chart for this quick tutorial. This is not the bubble part of the chart. It's before the bubble is here. So I'm gonna be using a more normal and realistic part of the chart, which is what you will find more often if you trade whatever cryptos or stocks or whatever you trade. Bubbles don't last that long, and this is much more common to find. So I'm going to be using this as an example. And the first rule is that you only trade uptrends. You never trade downtrends or trends that are going sideways. If you find yourself in a downtrend, you sell everything immediately and you get out of there and you find something else or somewhere else to put your money in. You only trade up trends. That's the very first rule to never break. The second rule is you only enter trades where your profit potential is at least 3 times bigger than your losing potential. And to show you an example, here we are uptrending, right? Okay, so when we uptrend, just like when we downtrend as well, we go in waves. So you have one wave here, impulse, retrace, okay? Impulse, retrace, impulse, retrace. You can identify the waves. I think it's easy to identify the waves here. Now, let's suppose that we are somewhere here and we want to enter this trade. Let's suppose the price is going down here. We have this red candle. We don't know yet where the retrace is going to finish, so we need to find out where our entry is going to be and what our profit taking is going to be. And then from there, knowing where our stop loss is going to be, then we can calculate if our profit potential is at least 3 times bigger than our losing potential. To do this, and again, this is not intended as to teach tools or technical analysis, but I'm gonna have to use them to show this example. So to identify the entry, let's suppose we're here somewhere in these red candles. So we use the Fibonacci retracement tool. We click in the point A, and then we drag to the top of the wave and click there. Now, if we're somewhere here in these red candles, we don't know where it will stop, but with this tool, we see that we have one Fibonacci line at 61.8, and then we have another one at 78.6. So we have 2 possible entry targets. One that it would be here, and the other one would be here. We enter the trade only when the price actually touched one of our targets and it starts to bounce. If the price it's not bouncing and it breaks our target entry and continues to go down, obviously we will not enter the trade. But if indeed our target entry is positive and we see the price starting to bounce, then we are going to enter the trade. Now, how do we know our target profit? For this, we need to use the Fibonacci extension tool. So we go and get the Fibonacci extension tool, and we do something similar, but this time will be 3 clicks. So you click first where the wave starts, then you click at the top of the wave, and then you click on the line where the price started to bounce. And now we have a few Fibonacci lines above, which is going to give you an estimate of where you can take your profits. Now, let's take, for example, the 1.6 Fibonacci line, because you need to be realistic and you need to be you need to have common sense and be a little bit tight with your money. You're not gonna go and risk going to the last line, because it's not very realistic thinking that the price is gonna touch the last line. How I would do it if I didn't know the future, I would take this target profit here. Okay, so if the price touches this line, I'm taking my profit. And if my trade was not positive and the price started to bounce, I enter the trade, but then it was a false entry and it starts to go down, I'm going to take my loss somewhere here. Okay? This, you just use common sense. If the price, so we enter the trade in the bottom line here. So I'm going to delete the other one. This one is not valid anymore. So we entered the trade here. It doesn't take a lot of brains to see that if the price goes below, like in this distance down, you were already wrong. You were wrong. It didn't bounce. So you take your profits. You take your losses as soon as possible, so you don't lose that much money. We can delete this now, and this will be our target profit, and this will be our target losses. Now let's see if this follows the rule that I said your profits have to be at least 3 times bigger than your losses. So we take the long position tool and you click on your target entry where you actually entered the trade, or where you were anticipating to enter the trade. And now it's going to give you this. Now we have to drag the green part to your target profit, and the red part you drag it up to your losses, target losses. Now we see that our target profits is 168% target profit. This is crazy. And your target losses, it's 21.50%. So your potential is that you can make 168% profit against 21.5% losses, which is a big loss as well, but the proportion, you're making way more than 3 times as much profit than loss if you lose it. So this is a valid trade that you could enter. Which takes me to the next rule, that is, never let your winnings run. Okay, so this is the perfect example. Say that you entered this trade and you did so good and you made 165% profits. But then after you take your profits and you get out of this trade, the price continues to go up to 240% profits. And you're like, holy shit, why didn't I stay in this trade? Why didn't I let it run? You know, and then you repeat this 3 times in a row, and it happens 3 times in a row, which will happen. And every time you take your profit, it continues to ride up, and you're missing out in a lot of profits. After this happened 2 or 3 times in a row, your mind is going to play tricky games, and you're going to start raising your target profits. But guess what? At the moment that you raise your target profits in that trade, the price will not reach your target, and it will continue to go down, and most likely you won't make any money at all. because these things happen. So you have to stick to the plan. You have to always take your profit where you planned it. And I recommend to be conservative in this. No matter how many times you miss out, you never break this rule. You always take your profits where your target profit was. No matter how many times you missed out before, you never break this rule. The same thing goes for your target losses. Now let's imagine that you enter a trade, but then it goes down. After it bounced, if it was a false entry and it starts to go down and it targets your stop loss. And so you take your little loss, but then the price goes down a little bit more and then it continues to go up and it goes up 200% profit. And then you think, shit, I was so stupid. Why didn't I put my my stop loss a little bit down below? It wouldn't have triggered it, and then I could have made 200% profit on this trade. And when this happens 2 or 3 times in a row, guess what? You are gonna start putting your stop losses down below so that you don't miss out. And what's gonna happen? That you're gonna be losing more money in the long run. This rule, it's never to be broken as well. Never let your profits run and never let your losses run. Always stick to the plan, no matter your past experiences, no matter that 3 times in a row you've been missing out. You always stick to the plan. And the last rule is you only enter trades when you have at least 3 indicators that confirm that the trade will be positive. Even with this, you never have 100% warranty that the trade is going to be positive, and you're going to have to take losses many times, probably 40% of the times. Because even if you want to be right 100% of the time, that is not true. If you're a very, very good trader and you know how to use the indicators very good, you will be right 60% of the time in average, and you will be wrong 40% of the times average. But if you follow these 5 rules, in the long run, you will be making money consistently. So only enter trades when you have at least 3 indicators confirming the trade will be positive. This is the perfect example because we have, when we did the Fibonacci retracement from point A to point B, if we were somewhere here in the red candles, the Fibonacci was telling us that it will most likely bounce in the 78.6 or in the 61.8. So bingo, you have a target entry here according to the Fibonacci, which is one indicator. The second indicator is you have the 50-day moving average around the same area where your Fibonacci lines are. Moving averages are one of the best indicators. They act as a support and they act as a resistance, and almost always they hold the price, or they resist the price, or they make the price bounce. They are very, very good support and resistance lines. So we had the 50-day moving average crossing around the same area where your Fibonacci entry lines were. So most likely it's going to bounce because it has double support, your Fibonacci line and also the 50-day moving average. Not only that, we had the RSI showing how it was oversold and starting to point up. So usually the RSI, you see, when it goes, it's overbought, it goes down. When it's oversold, it goes up. So it was oversold, telling us that most likely it's going to start to go up as well. So here we have our 3 indicators. We have the Fibonacci lines, we have the 50-day moving averages, and we have the RSI. 3 indicators confirming this will most likely be a positive trade. Even with that, as I said, you never have 100% warranties. Many times, actually 40% of the times, will be a false entry. So be ready to take your loss. So thank you very much for watching, guys, and thank you for the support, and I'll see you in the next video. Bye.